So thanks, guys, for taking busy schedules out of your March break. For those with kids, it's probably a blessing to get a break. Mine are in university, and they're now taking care of the pets. So, just a little background about myself. So I've been, without dating myself, over a quarter century in this business, and I've seen all the changes, the ups, the downs. When I started, things were kind of like the opposite of what they are now. The house prices were like super low and the interest rates were super high. Now what we're seeing is our very high home prices and very low interest rates. However, the interest rates are now moving up. We're promised to move up. We've seen a couple of movements recently, and most importantly, the house prices are pretty much stable. I mean, I haven't been seeing any drops since probably fall of last year. How about you guys? Are you seeing any movement in the market from fall of last year? Or is it pretty much flat?
Oh, New York has been down.
New York has been down, yeah.
Stagnant in Toronto.
Yeah, so it's, and by the way, this is an interactive seminar, so if you guys have questions along the way, feel free to ask or participate. And whenever markets are in uncertain times as they are right now, there's two ways to look at it. You can, jump out the window, or you can say, yay, this is a great opportunity. And from an optimistic standpoint, if you want to survive long-term in this industry, our clients, they need us the most. We're the professionals that they're counting on, so we're here to provide counsel. Now, obviously, you're not supposed to be experts on the mortgage arena, but you are supposed to have a general overview. And before the end of today's session, I'd like to fulfill two objections. The first one, obviously, I want everybody to be.
Sorry, would you please talk louder?
I'll try. Okay. The first objective, I want everybody to walk out of here nice and full, so pizza is on its way. Okay. And the second is to walk out of here with a little bit more knowledge and information than you currently have right now. So that's the objective. And I'm just going to briefly give you a high-level overview about the differences between a mortgage broker and a bank. We're going to talk about the different factors that determine interest rates and why there's so much confusion and speculation in the mortgage rate arena. We're going to talk about what's stressing all of us out, the mortgage stress test. You've probably heard what it's all the stress test all about. So we're going to dissect that into greater detail. And we're going to talk about the difference between insured, uninsured, and now the third caveat, insurable. Okay, so, and also the different options that are available through the broker circuit. So just by a show of hands, how many here have been in the real estate game less than 5 years? Okay, so about a quarter of you. Over 5 years? Okay, so we have a split group, which is great. And shortly will be joining me Annie Carpenter from Genworth Financial, and she's going to give more of a low-level overview about the rules surrounding the B20. You probably heard B20, B21. These are the actual stress test rules. Okay, so first off, who here knows the difference between a bank going directly to a bank and a mortgage broker? Okay, so a bank is basically giving you one choice and what we call a biased product. So they're gonna sell your client what they believe is lucrative for them to sell. And yes, they have some choices, and yes, we deal with the big banks, so I'm not knocking banks, but when you're dealing with a mortgage broker, we not only have access to the big banks like TD, Scotia, we also have banks that are called monoline lenders. Monoline lenders are the smaller players like MCAP, Street Capital, RMG, and that's all they do is mortgage selling. They don't upsell you products like RSPs, mutual funds, anything like that. And as a result, you're given a heck of a lot more choice when you're dealing with a broker, because we're dealing with literally 30 plus different financial institutions, and that includes big banks, that includes trust companies, credit unions, you name it. As a result, the product line expands. So we have products even for the most challenging of borrowers. For example, today we're seeing a lot of self-employed, commission, and contract employees. So BFS, that stands for Business for Self, commission, like you guys, and contract.
The BFS stands for what?
Business for Self, or self-employed. I'll just put self-employed. Now, in the self-employed category, there are three categories. There's the sole proprietor, partnership, or corporation. Each one of those are dealt with separately and qualified separately. Commission, same thing. The lenders typically want a 2-year average. And contract, let's say you have somebody working for, I don't know, IBM in the computer department, and they decide to go and do contracts for various different companies. So that's a contract. And typically a lender will look for 2 years average. Now, obviously, these three groups, they want to maximize profits and minimize taxes payable. However, the banking system is a little bit unforgiving, and they typically look at the line 150 of the notice of assessment, line 150. However, we have lenders that will, for a slightly higher interest rate, will look at only 6 to 12 months banking statements. Okay, so 6 to 12 months banking statements. And all they want to see are the average deposits that are going in so that someone can sustain the mortgage payments.
How high of an interest rate are you looking at?
So very good question. So right now, a person with perfect credit, perfect employment, they're looking at mid threes, maybe 359, 349. One of our lenders has a promotion right now, 1 year special, 3.79%. And guess what? The credit doesn't even have to be perfect, okay? If for whatever reason, like I have a case right now, what happened was husband and wife, title was in the husband's name, and his business wasn't doing too well. He's in the HVAC business. Wife is a real estate person. However, before getting into real estate, she had some bit of a rough patch. So safe to say both have credit blemishes. What happened was the husband, he was afraid that the creditors would start coming after him, so he transferred title into his wife's name. Okay, we put a private second mortgage on that property about a year ago. So long story short, bank is coming up for renewal, and they found out that title got transferred from the husband's name to the wife's name. So guess what? They're given two choices: pay out the loan or power of sale proceedings. So they contacted us, and basically through this program, we took the wife's last 6 months of real estate earnings, and even though her credit again isn't perfect, we managed to find a solution for them. 3.79% for 1 year, and after 1 year, with improved credit, we're able to place that client into what we call a mainstream lender or an A lender, offering slightly lower rates.
Contract employee.
Yes,
2 years.
Yeah.
Is remaining in the contract, or it has to be minimum 2 years?
it's from the start date.
So if they have 1 year left or 6 months left, would that count?
So as long as the contract, like if it's only 6 months left,
Yeah.
That's okay, as long as they have a 2 years track record
Or
in doing contract work. It's okay, because the lenders will understand with good credit, that most likely, if this person had a, 10 years history working with IBM or a large corporation, and they've already been working for 2 years in a contract position, most likely they will continue to resume their contract. And worst case, they can probably even go back to their place of employment. So again, it's very important, as mortgage brokers, we have very good reputations, and you can imagine after 25 years, people come and go, but the relationships don't go away. So we have very strong foundation and very strong relationship with a lot of the lenders that we deal with. So even if the contract is soon to end, we can more or less explain the story. Okay. Any other questions about these?
how the lender fees work.
Okay, so that's another good question. The lender's fees are typically various. So typically on something like this, with 6 to 12 months banking, the lender will charge 1% fee. And by the way, as brokers, we usually don't charge any fees. Our service is free because we receive a referral fee from the lender. In fact, we like to reward those that work with us, and we even have a realtor referral incentive program. In fact, right in your listing agreement or VRA, under finder fees or commissions, you don't even have to disclose the finder fee that you would receive from a third-party institution like us. What the finder's fees are for you guys, this it depends on the scope and nature of the deal, so you would have to come and speak to us individually about that. But we do offer a very healthy referral fee for you guys, and typically, in this case, we do end up charging a small fee, but not for your typical 90% of the population that will go to an A lender.
How is that finder's fee paid? Can you explain?
Oh, yeah, it's actually, once your deal funds, it goes directly through accounting. So when you guys get your real estate commission, you guys will also get right from the office. So check
Through royalty.
through royalty, yeah. Any more questions about this?
So what's the scope of the healthy fee? Like,
Well, it depends.
Give us a range, give us a range.
As a range, so it could be like 20 to 25 basis points. So let's say the mortgage is 500,000. So 1/4%, so 1% would be 5,000, 1/4 of that would be
$1,250.
$1,250, yeah. Puts a little feel into that.
The fee would be only 1% of the mortgage amount, and
Sorry?
the fee for the client who want to get the mortgage would be 1% of the mortgage amount. That's all they have. to-
Correct, yeah. Yeah.
Because sometimes big lenders have like 1% themselves, so that 1% belongs to the bank or belongs to the mortgage broker.
Okay, usually 1% goes to the lender, and sometimes the lenders, the broker will charge on top.
Yeah, this is the.
Yeah,
So.
But in most cases, we don't charge. In the difficult cases, we have to.
Okay.
Yeah,
So if you have to, then what is the charge?
usually 1%.
Okay.
It could be between 1 to 2.5%, and I'll give you an idea. For example, let's say, in those cases, I said somebody, has poor credit, but they're showing some kind of commission income going in. Let's say they're not working at all. Let's say they're waiting for a job or life happens. So we have programs with certain lenders that will charge a higher rate, like maybe 8%, could be between 8 to 12%, but then the fees have to increase. So everything is proportional, okay? But again, every case is a little bit different, and we can discuss the fees individually, okay?
Foreign buyers get nailed for higher fees?
No, we have programs for foreign buyers, like 35%, so no fees in those cases. But that's a very specialized program, we can talk about it separate.
With these lenders, usually what will be the down payment?
With these ones, at least 20% minimum, yeah. So you guys probably know about insured versus conventional. Insured, it's up to 20% of the purchase price. So that's the down payment. So if it's less than 20%, the mortgage has to be insured, and there's typically a premium. And that premium, it's tiered. So for example, if your client is putting 5%, that fee could be 3.75%. If they're going with 10%, the fee will drop to 2%, 15%, 1%. Like this is just as an example. I don't know 100%, but this is a very accurate example. And with 20%, there is no fee. This is technically an uninsured, a conventional mortgage, or conventional is the same thing as uninsurable. By the way, if the purchase price is $1 million and up, according to the new rules, this mortgage could not be insured, which means that the client has no choice but to put the 20% down payment. Now, since the stress test introduction, we now have a third category called insurable. And this is what's causing most of the confusion in today's mortgage rate marketplace. Why? Because somebody could be on Google searching mortgage rates in Ontario, and they're going to see rates starting as low as 2.74%, 5 years fixed, or prime minus 1.04%. By the way, prime today is 3.45%. And the difference between fixed and variable right now is about 0.5%. So if your clients are asking you, what should we do? Should we go fixed or variable? I mean, it depends on the comfort level of your client. And it also depends, what's very important for you guys is, will they be selling in the next 5 years or not? Because for sure, if they're going to be selling in the next 5 years, you don't want to put them into a fixed. Okay, if they're selling, make sure they're buying something. Then it's safe to go into a fixed. But if they're selling and leaving the country or whatever, there's going to be only a 3 months interest penalty if they take the prime minus or variable product. If they take the fixed, there's what's called 3 months interest penalty, or IRD. And IRD stands for interest rate differential. This is a formula that only the lenders know. And they do this almost on purpose to penalize the borrower for breaking that contract, that 5-year term. So if somebody is taking a 5-year fixed, we're going to make sure to counsel them on all the pros and cons, because people are enticed by the super low rate options out there, but it comes with a price if it's the wrong product, okay? And again, back to the difference between a broker and a bank. A broker will sit down with your client and explain all these pros and cons. The lender, let's face it, they're working for a bank. They're not just selling mortgages, they're doing RSPs, mutual funds, and the whole rest of the gambit of products that the lender would sell. Okay?
So the 3 months is for variable only, and the IRO is for fixed.
Yeah, so IRD, sorry, IRD
Is for fixed.
is for fixed. 99% of the time is going to be the IRD, not the 3 months interest penalty.
Can the fix be portable as well?
So, good question. Yes, it's portable and assumable. So what's the difference? Portable, that's in the case that your client sells the property and purchases another property. But be careful, the closing dates And again, depending on the institution, they have to coincide. Some of the institutions will want the closing date to be exactly on the same date. Some institutions will want it to be no more than 2 weeks apart. Others may give you a little bit more allowance, like maybe 3 months apart. So this is a very tricky tool. It's still for the benefit of the client, but your client has to look into the fine print and what each lender offers on the maximum portable time frame. Okay? Assumable.
Anybody has a red Toyota license number BRKW858? You're wearing red jacket and red Toyota, so
They're matching.
thank you.
Now, let's say your client is stuck in a fixed rate, but they have an attractive 5-year fixed. They took it at 2.74, and today's best 5-year was, let's say, 3.59. So it's probably attractive for them to take over that 2.74. In this case, they would assume that mortgage if they qualify through that same institution. Okay? Any questions about it?
Sorry, I didn't get assumable.
Assumable, so let's say your client purchases a property and they take a 5-year fixed, and they sell the property and they don't buy anything else. The purchaser of that property, if they qualify, can assume your client's mortgage at the low rate. Yeah, we had another question.
Does CMHC still have in place that after a certain time on the fixed mortgage becomes automatically 90 days penalty? There used to be that product that after a year and a half or something of payments, it doesn't become it's only 90 days.
No,
That disappeared?
yeah, there's no option like this. Yes.
You mentioned insurable.
Yes. Yeah, this is what I was going to go.
Leo, our guest there.
Oh, hello, Annie. Welcome.
Thank you.
This is Annie from Genworth, and she's gonna continue shortly once I go over 2 more points.
274 is a right fix for today.
So, actually, I think it's more like 2.94.
For
five
variable
years,
fix or fixed?
Fixed, not variable.
2.9, 2.95?
You could see low options like
I
this,
had
but
it at 3.39.
yeah, that's more than
It's
normal.
not 274.
We do have,
You have it?
but it has to be insured or insurable. And I want to explain now the difference between what is insured and insurable.
Just a quick question.
Sure.
Over the million, how does it go?
This is 100% has to be conventional. So over $1 million, you have to put.
But after the million, should they from the 50% or still 20% is acceptable?
Okay, so different banks have what's called a sliding scale. Okay, so let's say if it's up to 1.5, they're going to want to, let's say the purchase is 2 million. Okay, 2 million. Up to the first million, they have to put minimum 20%. For the next 500,000, it could be 50%, and thereafter it could be another percent. But again, this all depends on the lenders. There's no hard and fast rule. Every lender has a slightly different sliding scale. But none of these are insurable.
So you mean on a $2 million, on $1.5 million, $2 million home, they gotta put in $700,000 cash?
Yes, at least, yeah. Yeah, because there's a sliding scale.
Between 500.
Okay, so if it's over 500,000, if they're going with only 5%, they can go 5% of the first 500 and 10% of the difference afterwards. So let's say it's a 700,000 purchase, and the client wants to go insured. And Annie, correct me if I'm wrong. Let's say it's a $700,000 purchase. The borrower is allowed to put 5% of the first $500,000,
Yep.
500,
Mm-hmm,
and 10% thereafter.
exactly, on the balance.
Perfect.
So that's $45,000.
Is it
They're not
flat?
insured. It's not insured
This one is insured.
for 15%.
So 5% of 500, right? So that's 25,000 down payment, and 10% of
45,000.
200,000, which is 200. What is it? 20,000. So total would have to be 45,000, and then it's insured. Now, back to what is insurable. So let's say you have a client that is trying to refinance their mortgage or transfer. It doesn't happen, you guys probably don't see it too often, but I'll touch on it just in case, because there's a lot of debate about rates. So basically, insurable, it could be a home that's worth, let's say, 1.2 million, and they have a mortgage of 500,000. The lenders rely on what's called a loan-to-value ratio. Loan-to-value is when you take the mortgage amount and divide it by the purchase price, okay? And if the loan-to-value is 65% or less, they get the best rate category. We'll call it A rate, okay? If it's between 65 and 70%, so let's say the A rate is 3.29%. The next category could be something like 3.34%. And if it's between 75 and 80%, this is another category, C, it could be 3.39%. So as you see, the lower the loan to value, the more attractive the rate is for the borrower. There's one more important point here, and that is, one second, I just want to work out the loan to value here. So in our case,
Is it 500 to 1.2 or 1.2 to 500?
so 500,000 is the remaining mortgage, and 1.2 is the market value of the property. So how to calculate the loan to value? You have to take this and divide it by 1.2. And we're getting a 41% loan to value in this case. Okay, and yeah, so one other important factor is when is the closing date? If it's 90 days or less, they're going to get, again, another rate category. If it's 120 days or more, then they bump up a slight premium. There's another confusion point here. If the loan amount is over 600,000, or if one of the borrowers has a credit score of less than a certain amount, for example, 680, which is the score, these rates are subject to additional premiums, 25 basis points, 35 basis points. So the whole point of this is not to confuse you, just to explain to you that there's a lot of confusion in the marketplace today, and we're here to try to navigate through that confusion and sit down with your client one-on-one and explain. It's kind of like not knowing the problem you don't think you have. When you know you have a problem, you need explanation. So, and we have the solution. That's the beauty of it, okay? We have solutions for the most credit challenged scenarios, as well as for these rate options. Any questions so far? Yes.
Is there a scenario where if they had less than 20%, but the seller is prepared to take back on second mortgage?
Yes.
Can you structure the deal so that you're selling the second mortgage as well? And then can we add that amount on to the end price in order to avoid that insurance fee?
Yeah, so in other words, your question is, let's say you have a purchase price of $1 million, and your client only has 15% down payment of $150,000, correct? The lender will lend only 800,000, but where is the client gonna get the other 5%, the other 50,000? We do have options for private seconds. An excellent question, by the way, that they will go up to as high as 85%. Back in the good days, when the market was more stable and we knew which way we're going, we could go as high as 90%, even 95% on a private second. Right now, there's a lot of fear from the private sector, and they're trying to mitigate that risk by going not higher than typically 85% of the loan to value. But we do have private second mortgage options
The
available.
first mortgage will not be affected in this. The first mortgage application will not be affected.
No, it should not. Now, sometimes if the first lender, the bank says, no, we will not allow a private second behind us, then you have no choice. But most of the times they allow it as long as the ratios will debt service.
What are the rates on the second mortgage? What are the rates on the second mortgage?
On which the private, so they start at 8%. Well, sometimes we have promotions like as low as 5.99%, but it could be as high as 14%. It all depends on the type of property, the situation, the location of the property. There are a number of factors that are involved in determining the rate. And just something to leave you guys with.
Are you gonna, can you define insurable? I don't think you've done that. Have you?
Yes, that was basically the
Oh, this is
insurable,
insurable.
that was basically the different loan to values, yeah. So guys, do me a favor, do yourselves a favor, grab your phone if you can, if you have one, and type in www.leofalkovsky.com. This is my website, and the reason I'm bringing this to your attention is I also have my own podcast show, and it's really built for the real estate agents like yourself. There's going to be tons of value bombs, golden nuggets here. I interview top performing real estate coaches like Bruce Keith, that's been a regular here at the YCR. We have top performing real estate agents. Check it out, guys, and join our private Facebook group as well, only for realtors, where you can post your exclusives and kind of like our YCR community must-haves and wants. And this will get you a little bit added exposure. So just a little tidbit from me, and I'll be around for any questions. But before we proceed, I think the pizza is here. Maybe let's take a break, grab a pizza, and Annie will
I
begin
didn't want to
her.
stand between you guys and lunch, so.
Exactly. I promise to have them full. So guys, take a break, have some pizza, and we'll come back. The more important.
How are you? Oh, my pleasure. Yeah, sure. I thought it was being there, but then obviously, like, I ended my presentation at 20 to 11, but then right, so. Hey, what's the deal? I don't think he was there. I didn't see him there, so, yeah, so, it was a good group, yeah. Yeah, it was like a monthly meeting. Oh, with you. Oh, yeah. It was okay, yeah. The parking is a bit of an issue. So I parked. It's not here, it's so tight to find.
Oh, that's,
Well,
that's, I can't find it on .com, but it's,
Yes.
yeah, that's it.
Yeah.
Yes, that's CH.
Oh my God, that was so. No worries. I was like worried about that. I'm like, I love that too. That's a surface, right? Yeah, I know. I have the same thing.
So, yeah, it's one of those.
How are you?
Missed we gave us a break and we got pizza, so we thought I'd come quickly. No, that's just how that.
Oh, yeah.
Did you forget your purse? من خودم رو دارم آهم به خاطر نه من یه گرفتم مارچ 13 چون من 3 تا ایمیل مختلف دارم من گفتی به من چک کردم دیدم اون برنامه اومده I think it goes by how much you spend each month, right? So yeah, if you spend a lot say send you 5 invite to that email. That's it. من یه شیر پاپکورن دارم واسه خودم. استفاده نمی‌کنم. Perfect. That's actually a good idea.
How's my neighbor? How's my neighbor? Where is that? Yeah.
Yeah, and it depends on the different factors. It depends because lenders have their own algorithm to determine the risk exposure of the class, right? So it could very well be credit score, the loan to value, if it's insured or uninsurable or non-insurable. So the rate will be depending on that as well. Yeah, product, rental, or owner occupied, right? So it depends on a few different factors.
They all look at you. You're successful.
Yeah, but I have 18 years experience. So how do you feel? That's good.
How do you like the new building?
I love it.
Face no, nothing.
I taste noise, but I bought. You know, it's a treat.
Oh, so you want something like that? You guys are blocking my view.
Yeah, I know that. I'm sorry for
Oh
this.
my God, I was having a $1 million view.
No more sunset.
Thing I don't get. Last night I got it.
So I think 20%.
That's the
So I'm sorry. I hope nobody's coming.
Why did you farm the
Yeah.
send out flyers? I have a lunch or something. I go there.
Okay, don't have.
I started with a week.
Makes it easy.
Yes, yeah, absolutely, yeah, that's right. Oh, no.
Yeah, I know. I'm not getting any showings over there.
This year is not. Yes.
Oh, yeah, grab it, I can, go for it. Go. I don't mind, because I think it's just too early for me right now. Yes, exactly, exactly. No, absolutely.
It's not. No, I think.
Okay, okay.
Like you're gonna go so much in, or if you change color, it's like. So you're gonna know how much it's gonna be consistent. So you have to much more to change the color. I like a nice cake or something.
Okay, in about a few minutes. Everybody has the pizza.
Yeah.
Can I have some more?
Yeah, I know.
Oh, yeah, okay, well, okay, do we have a lot of people,
Which is not too.
Yeah.
Yeah.
I've seen you before, like, you look super familiar. I know, where, have you always been here?
I'm doing lots. 8,000 Stone Street. So
I don't know, you look familiar, I must have seen you in another function or something.
All aboard. You're leaving. promising every day tomorrow, but sometimes it doesn't work.
So guys, we have a guest expert here from Genworth Financial, like I mentioned, which is a private insurer, and this is Annie Carpenter. She's been with them since she was 12, 16
Yeah,
years.
they're working, child labor law, we're different. So, yeah.
And Annie's gonna go a little bit more in-depth about what we talked about, insurable, B20, B21. That's why I didn't want to go too deep into it. This is what Annie will.
Thank you, thank you.
Thank you.
Is lunch good? Yeah. Perfect. So I'm really happy to be here. Thank you, Leo, for inviting me. As was mentioned, my name is Annie Carpenter, and I am one of the account managers for the GTA. What's that? I don't want you to trip. I'm one of the account managers for the GTA, mostly the GTA North. I also manage a relationship with a lot of the mortgage financing companies that Leo deals with, such as Street Capital, MCAP, RMG, Merrick's, Paradigm Quest, Equitable Bank. So I started Genworth back in 2000, whatever. 16 years ago. 2001, thank you. Someone is better at math than I am. So, so as you can tell by my French accent and the French name, I'm originally from Quebec. So I was born and raised on the Quebec side of Ottawa, so Gatineau. Moved in Toronto back and forth. I lived in Montreal for 10 years. So if you want to practice your French, you're absolutely welcome to come and talk to me after the session, and we can chat in French. So my role really within the industry is mostly from an educational purposes. So I support people like Leo to help you guys understand better what's been going on in the industry in terms of the changes, because we all hear what the medias are saying, but sometimes it's not all the truth that is being portrayed correctly in the media. So we're here to clarify the regulations for mortgage insurers and for lenders as well. And second part of my role also is to support Leo when those applications are coming in, right? So if you've got, obviously we're regulated by OSFI on a lot of different factors, and we'll talk to that later on. And I'll show you what insurable deal means, what the criteria for an insurable application is. But let's say you've got a more difficult application that you're sending to Leo, and it's not a B deal, it's not a private lender deal, but there needs to be a little bit more creativity in terms of the way that the deal is structured. So Leo would work with people like me to help structure the application, support when the deal gets submitted to a lender, and then we want to understand the story behind the application so that we can make the right decision for your client. We want to put the right people in the right homes for them. And then by doing that, or in order to do that, we need to be able to talk to each other and understand what the situation is and why it makes sense for the client to be buying a property at this time in their lives. So who is familiar with Genworth? If you're Real Page, you must be familiar with Genworth because we're all over your newsletters and everything, because we do have a very good relationship with Real Page altogether. So for those of you who are not familiar with who we are the largest private mortgage default insurer in Canada. There's 3 of us. CMHC is the government entity. We're the largest private default default insurer, and there's a smaller private default insurer as well that is called Canada Guarantee. We're all regulated by OSFI. So as 2-3 years ago, we started being regulated by OSFI, which is the Office of Superintendent of Financial Institutions. And obviously the government wanted to start implementing some changes to slow the market down. We'll talk about that later on, but essentially we're specifically, we're specialized in residential mortgages in Canada. So not only first-time home buyers, but those individuals who are investing less than 20% down payment. And now with the new B20 regulations, even people that are investing 20% down payment or more might choose to go insured just because they can benefit from a lower interest rate. So we've been established for over 20 years, and we're dealing with over 250 lenders across Canada. So all of them have policy. They all have policies that are with Genworth. Some lenders may have an automatic allocation model. So if you're dealing with Leo, he will be able to go with the lender that will be able to offer the product that is customized for your client.
I had a question in my mind because once we had the deal and our client went through you guys and other companies which they insuring the mortgages, and the price that you guys have to charge way was higher than the others. So, you were saying like 17,000 something, others say 9,000. As different. So, and I always had that question mark in my mind that how come they charge that much more?
Okay, and that's a good question. So essentially, because we're all regulated by a government entity, our rate premiums are exactly the same from one mortgage insured to the other. So it's just important to understand that we're different from any kind of other creditor insurance or life or disability insurance. It's completely different. We will be insuring a loan when the client has less than 20% down payment, and this is intended to protect the lender. And the more down payment the client will be investing, the lesser the premium will be. So it actually depends on what loan to value the deal had been submitted at. So let's say the deal on one lender, it might have been submitted at with 10% and the other one with 15% down payment. It would have been a different premium, but had it been submitted within the same product and same loan to value, it would have been the same premium.
Actually, it was the same scenario.
Okay.
The buyer went with a mortgage broker who was working with Genworth, and they come up with like mortgage insurance of 17,000, and then they said we don't have that much money. Huh?
Was he business for self? Your client?
No. Just
yes, I'd have to take a look at this application on just one-off, maybe offline, because we're all, it's all the same price from Canada Guarantee, Genworth, CMHC. We're all the same price. There's no difference in terms of the price. So it should not be different from one deal to the other, but it depends on how the lender submitted the application, right? It could be a different product, it could have been a different loan to value. So that might have explained the reason, but I'd be happy to take a look.
Thank you.
In a scenario like hers, let us say hypothetically that Genworth did make a mistake, and they charged $17,000 instead of $9,000.
Okay.
So would her client be entitled to get a refund?
We have to understand what was the difference, because everything is calculated. There's not really any human factor that is calculating the premium. It's all within the system.
Input the data incorrectly, he could have been hit the wrong way.
Yeah.
So I'm just wondering if what she's saying is correct, hypothetically.
Yeah.
Hypothetical. We're not pinning you down.
Yeah. No, I know. I'm not taking it that way either.
Okay. So if hypothetically she is correct, that the other lenders were going to charge $9,000 and Genworth has charged 17, can there be an adjustment? I just want to know, just so that we know what's up.
Yeah, and it depends. It depends on the reason why. Usually, we also have to understand that before the client closes the mortgage, then they actually have a breakdown of the premium and all the costs associated. So if they would have had to speak up before the actual funding date. Once the deal has been funded, then the lender has signed that they're agreeing that this is the nature of the contract, loan to value, down payment amount, product type, premium that is associated, right? So it's a lot more difficult to correct something that has been agreed upon within the client upon closing. But that being said, if let's say it's in the process of, you're submitting the deal with a broker and then the client goes with his own bank, and then they're getting two different scenarios with two different pricing, then I've got the two deals, so I would be able to compare, hey, here's how the deal has been submitted, how different it is. So if you want to have the $9,000, then this is how you have to submit it, right? So that's kind of how.
The mortgage broker give you any explanation?
No, this is my guess only, that might be the first mortgage broker which was working with Genworth probably did like
Maybe he.
paperwork with the husband, which is he had their own business, but the other agent of mortgage broker
Maybe they were the agent's
applied for the
commission.
woman.
It could have been. It could have been that, you know, one of mortgage brokers might have charged a fee as well, like a administrative fee or a broker fee. I don't know, and that's why until we actually see the file, it's difficult for me to comment. But in terms of premium, guys, the premiums are all the same from one lender to the other, from one mortgage insurer to the other. So, but that's a very, very good point. Okay. Everything that we'll be talking about today, everything is on our Genworth website. So if you want to save this website on your favorite, I can actually show you, I can do a demo, because there's something else I want to talk to you about, how to use some of the content and marketing content that we can, that you can use free, and that you can use to advertise some of the products that we'll be talking about today. So if you go to genworth.ca, this is how the genworth.ca website looks like. Under realtors, we've got a brand new section only specifically for realtors. If you prefer to have the Genworth app on your phone, which, you know, could benefit you if you're into financial discussions with your client, you can download the Genworth app, which is a mobile app. It's not on the App Store. You just go on a mobile or internet page on your phone. You do genworthmobile.ca, and then this is just the page that we can use to save on your desktop or on your main page on your phone. So all the products that we'll be talking about, lender updates as well. So if you've got questions on the B20, B21, when it's been communicated, what is the nature of all those changes, you can go to here. It says publications, and then our previous lender updates going as far as, I think, at least 3 years. Everything is posted on there. So you'll be able, everything is public knowledge, publicly known information. So you can click on publications for you to take a look at the changes. So who's been in the industry since, or for 10 years? Oh, a good bunch of you. So you guys are troopers, because we've been through a whole lot of change ever since 2008 hit. And that was in direct response to the market conditions being kind of risky from a government standpoint, but also wanting to protect home buyers and consumers against indebtedness. So I'm not going to go through all the changes. And I think Leo mentioned one of the most recent changes back from 2 years ago was to implement a new way or increase down payment for properties that would be in excess of $500,000. So if your client are buying at $500,000 or more, they have to invest a 5% on the first $500,000, and anything that is between $500,000 and $1 million, because we can't go any higher than $1 million, is subject to a 10%. So it's not a 15% down payment that is required, right? So because we are calculating what is equivalent to 5%, what is equivalent to 10% of the remaining amount, we calculate that together, we add it up together, and then we divide it by the purchase price, and that's what's determining the loan to value. So essentially those regulations are encouraging people to put a little bit more down payment, but they're still staying within the 90.01 to 95% loan to value, which the premium is the exact same. Okay, you're welcome to take pictures of the slides if you want. So B21 regulations back in October 17, 2016. That was the first set of regulatory changes that the government implemented. And that first set of changes, B21 or Bill 21, was affecting only mortgage default insurers. All of them. It's a federal regulation. So anything that we'll be discussing in terms of the federal regulations, we can't go any higher than, or we can't we can't do any different than what the government is saying, because they're saying that anything that would go outside of these regulations would be deemed uninsurable, non-government guaranteed. So the first set of change was back in October of 2016, which stipulated that we need to implement a stress test on all insured business, regardless of the loan to value. So you could have a client who puts 5% down payment or 25% down payment. If the lender is insuring the loan, your client is subject to a new stress test, which requires the client to qualify on the BOC rate, the Bank of Canada posted rate that is published on a weekly basis, but it hasn't changed for several weeks now. It is now set at 5.14. So as you can imagine, that has affected quite significantly first-time home buyers following these set of guidelines. So back in October 2016, then those rules were effective 2 weeks after they've been announced. So October 17 or through 2017, we've seen that a lot of first-time home buyers were so affected by the fact that it was becoming so much more difficult for them to qualify for an insured mortgage that we saw them do anything that they could to come up with a 20% down payment. So 2017 was the year of the Bank of Mom and Dad. So we saw a lot of first-time home buyers coming up with 20% down. That was coming from mom and dad's free and clear home that was refinanced so that they could give their kids a living inheritance so that they could buy their property. It was much easier that way to qualify for a conventional mortgage than it was for an insured mortgage. That was implemented in the optics of protecting home buyers if the interest rates were going to be increasing. And I'll go through some of the changes. This is something you may find interesting. Although we're using what the stress test used to be here at 4.64, that was the stress test back when the regulation had been announced, but it just gives you a picture of how affected those transactions could be. So if you look at example number 3, which is the most relevant within our market, let's say you've got borrowers that are making $132,000 a year. They're buying a property, 5% down payment, and it's a 5-year fixed rate, 25-year amortization. With the old rules, so before B21, they used to be able to qualify for $850,000 purchase price. With the new rules, that has gone down to $680,000. So a huge impact on my buying capacity if I'm a first-time home buyer and I need to have an insured mortgage. So there needed to be a mindset change on behalf of first-time home buyers, because you can't go for that $900,000 home right from the get-go. And for those of you who are millennials in the room, we want it all right away. You have to pretty much adjust, right? So because of those new regulations, either your mom and dad are helping you to be able to buy that $850,000 home with a conventional mortgage, or you have to settle for something a little bit smaller.
Is this on your website?
This slide per se is not on our website, but you're welcome to take a picture of it on with your phone if you'd like. Because we don't, yes?
Would you be willing to email us this slide?
So what I can do is I can just take it. So this slide here, what I can do is just put save it as a PDF, and I can send it to Leo, and he can flip it over to you if you'd like.
In your previous slide, the GDS was 39%.
Yes.
Is that still the case now?
It is still the case. It is still the case. Yeah.
It should be 32, 35.
You're stealing my thunder. No, it's a good point. I'll go through it, but it is still the case. It's 39 and 44 GDS and TDS that we could go to. And because there's a reason for that. So we'll do the PDF version, and I'll send it to you, Leo, no problem. Okay. Does anybody remember back maybe 3-4 years ago what every media was talking about, a specific type of property that they were all concerned with? Condos, exactly.
The sinking property, or then
Sorry?
the sinking property that was those townhouses that were sinking.
No, so actually it was a type. So as an industry, the medias were were concerned with condos. I heard someone say condos, so multi-units. So everybody was concerned with how many condos are being built in the GTA. There's just too much inventory, and there's just too many vacant condos. And what about all these foreign investors that are buying our condo? Blah 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 blah. So, anyways, as a result of all the concerns as an industry with regards to condos, then the government started to slow down approving new condo buildings from being approved for building. So that, in comparison or in addition to the rules changing for clients, that you can't buy that $850,000 home now, you have to settle for something smaller. We've got the highest rate of homeownership in Canada. What do you think it is, the homeownership in Canada?
70%.
70%, perfect. So we've got the highest rate of homeownership in Canada in comparison to other countries. So new immigrants, newcomers to Canada, millennials, new household formation, it is ingrained in our mentality to own our own home. So don't give me all these regulations and give me all the reasons why I can't buy a house. I still want to buy a house. I'm not going to settle for a rental or renting a property. I'm still going to want to buy a house. So you know what? I'll buy a condo. If you don't want me to buy a fully detached home because it's too expensive, I'll go with a townhome or a condo. So as a result of the government hearing all those concerns about the industry regarding condos, slowing down approving new condos to be built, then again, that has caused some people to go towards the condo option. And we've seen in 2017, and you probably have noticed that, 2017 was the year where we were actually getting multiple offer situations on everything, but we were starting to get a lot of multiple offer situations on condos, which we hadn't seen in a very long time. So all of those rules were made in the optics of slowing the market down. So the government wanted to slow down the GTA and the GVA, but because they are the federal government, you can't just really regulate two markets, and especially because they're highly populated. So if you want to get your votes, then you have to be pretty much creating laws across the board. So these are the regulations that were also affected, came into effect at the same time as the B21 regulation. That was the rest of the B21 regulations. And as you can see here, new low ratio eligibility criteria will mirror high ratio criteria, which means that these are the criteria for a deal to be considered as insurable, regardless of the loan to value. So for a mortgage application, for you to consider it to be an insurable mortgage, it has to fit within these guidelines. Otherwise, it goes into either a private lender, B lender, or the client has to go conventional without mortgage default insurer, and then the lender would have to take it as a conventional deal and keep it in their books. So in a nutshell, what they are is that it's only purchase transactions that we do. We no longer are able to do any refinance transactions, and that will come very, it's actually very important to know that because of the Purchase Plus Improvements program that we will talk about later on. So we do not do any refinance transactions anymore unless a client goes with a lender and doesn't have any mortgage default insurer. But if you're, there's only a few sets of lenders that are still offering the refinance because they are a balance sheet lender and because they can keep those loans in their books, right? So, so that has affected the market quite significantly. Maximum 25-year amortization, property value cannot exceed $1 million for a loan to be considered insurable. The minimum credit score is 600. Anything that falls below that is non-insurable, non-government guaranteed. GDS TDS 3944. Our system has the ability to approve automatically auto decision a file up to 39 GDS and 44 TDS. There used to be a rule whereas if you've got a 600 beacon score or lower, you're limited to 35 GDS and 42 TDS. And one insurer still has that regulation. From a Genworth standpoint, we said, you know what, government, you're already requiring clients to qualify on the VOC rate, which is a lot higher than the actual rate that they're paying. So we don't want to penalize them even more than they already are. So we are allowing them to go up to 39 and 44. Now keep in mind that the deal needs to make sense for us to go up to 39 and 44. If I've got someone who's got a low job tenure, I've got a 5% down payment that comes from a gift, and I'm right there, very high in the GDS and TDS, and I've got a so-so credit score, I may be tempted to increase down payment to alleviate some of the pressure on the GDS and the TDS. But then again, Leo is your mortgage partner, so he'll be able to structure the deal so that it makes sense for the client that to have the best chances to be approved. Okay. The other thing also that changed is rental properties here that we only do 2 to 4 units. So the client will still have to come up with 20% down, but we can no longer insure 1 unit. And I don't know why the government has implemented that rule, but in my own opinion, I think it might be because of speculation. So a lot of people buying just 1 condo unit as a rental. The government wanted to kind of slow that market down as well. So they might have that. I'm just speculating that this might be the reason why they've implemented that rule. So now it's only 2 to 4 units, non-owner occupied, that will be eligible to mortgage default insure. Keep in mind that lenders will still be able to do it conventional without mortgage default insurance, though.
They don't have to be in the same building, right?
So this would be, so 2 to 4 unit would be like a duplex, triplex, or fourplex. So they have to be kind of together. So we can't insure just 1 condo unit or 2 condo units, right? It has to be kind of it's considered a 2 unit or a duplex or.
But why would you insure it? If it is rental property, they have to put 20% down.
Mm-hmm.
So why do they?
Some lenders will insure pretty much everything on their books because that's how they can capitalize, right? Especially monoline lenders or mortgage financing companies, such as the ones that I mentioned earlier, that specialize in mortgage business only or mortgage broker lenders. The way that they can generate capital is by securitizing their mortgages, right? You can only securitize insured business, or it's easier to securitize insured business. Conventional business that is in your books, it has to stay in your books. You can't sell it. So the purpose of being insurable versus non-insurable is that lenders will use their portfolio of insured business. They would sell it, and then they can generate capital as a result of that, and then they can continue to be more competitive in terms of the interest rates that they're able to offer on different products as well.
They don't remember 2008 yet.
Sorry?
They don't remember 2008.
They don't. And that's why, I mean, these are affecting us. When they were announced back in 2017, they affected us quite a bit because in the refinance transactions, we had anywhere between 40 and 60% of all of our transactions that were refinanced. So that has affected us quite significantly. So we were not happy about that, but what can you do? It's the government. So yes, sir.
Single family with a legal basement apartment.
Yes, that would be considered a duplex.
Okay.
Absolutely.
Okay.
That's a very good question. So these are the impact of the 2016 stress test. So you can see here the areas that were the most affected: Toronto, Victoria, Vancouver. Actually, we were the ones the most affected by it. So 530 transactions were impacted, which ended up being overall in Canada, national 22%, which means that 22% of all first-time home buyers were priced out of the market. You can't qualify anymore for a purchase of your first home. So these guys were left on the sidelines. So unless they had the 20% that came from mom and dad, really, you had to wait until you either got the 20% down or that you buy something smaller that you can qualify for.
But if they want to slow down the foreign buyers, they're doing the.
Yeah, and to your point, this is actually only 5-6% of all transactions. I heard 9 at the very high peak, but 5-6% of all transactions are made by foreign investors. So it really isn't that significant. So as the government wants to slow the market down with all these restrictions, we're still facing a supply-demand situation in the GTA area, right? You guys are in that market. You know, I'm not teaching you anything new here. But the GTA, just like the GVA, Greater Vancouver area is limited by the mountains. They can't go any wider, they have to go up. So that's why we are seeing a lot of condos. In the Toronto area, we're limited by invisible mountains, and you guys know what they are. What are they? The lake and?
The regulation, the
green belt, right? So you can't build on the green belt unless the government is approving new land for building.
Are they planning to?
And that's my point, because right now the government is still being very diligent at approving new land to be released for housing, right? So yes, I think it's a good thing for us to kind of, protect home buyers from buying something that is too expensive, especially if we're in an environment where the rates is going to be increasing, not significantly, but probably over the next few years, we're going to see a slightly higher interest rate. But at the same time, if you really want to slow the market down, you have to open up. We're in a restricted market. We've got a lack of supply still, maybe not as bad as last year between January and May, but we've got an influx of newcomers in our country. I'm saying here, new to Canada individuals, millennials who are wanting to buy. Again, it's ingrained in our mentality to own our own home, to be in charge of our own equity and our own finances, right? And we've got new household formation as well. So all of these new entrants in our market are contributing to a very healthy market. But if you're restricting accessibility to mortgage, that will be one of the effects, but maybe not as much as if we were alleviating the market by creating more transactions opportunity. But again, the government is taking that into consideration, but they're still kind of waiting on that. Now come January 1st, 2018. That was the second set of regulations which were implemented at the beginning of the year. So essentially, all conventional business, your client needed to qualify on the stress test, which was different than an insured business. So your stress test would be the contract rate plus 200 basis point or 2%, or the BOC rate, whichever is the highest of the two options. Don't ask why the government is implementing two different rules for insured and for conventional business. I don't know. I thought it would have been a lot more easy to be all in the same playing field, but it is still different. So your insured client has to qualify on the BOC rate at 5.14, and your conventional client has to qualify on their contract rate plus 2%, or the BOC rate, whichever is the highest. So there's anticipation that this also will be affecting the market. Here it says CREA has predicted that the national sales would be dropping by 5.3%. Again, it remains to be seen because we're still pretty early in the year, and we can't really compare it to 2017 because, again, we were experiencing an anomaly in the market. We were seeing home price appreciation of 27, 32, 33% year over year. In some markets, like I think it was Barrie or Hamilton, was 40%. 40% year over year increase. This is nonsense. So even for a first-time home buyer, unless you go in firm, you really didn't have any buying power because you were competing against 30, 40, 60 other buyers as well. So it needed to be balanced, which this is what we're seeing right now in the market, whereas we're seeing a bit more inventory, the prices have stabilized themselves, but then again, this is in response to what needed to happen based on what we experienced at the beginning of last year. So if we do a comparison, Leo must have talked about it earlier, but a lot of lenders will now be pricing their insured business because everybody wants to have more insured business. So lots of lenders will be pricing their insured business, not necessarily only high ratio, but insured business more competitively than if you have a conventional mortgage. Because a conventional mortgage, you have to keep it in your books, whereas an insured business, insured loan, you can securitize it to create capital. So if you compare, let's say we compare a purchase of a condo for $400,000, $450,000, down payment is 20%, 25-year amortization. Now I know that your client can go up to 30 years on a conventional mortgage, but let's just compare apple to apples. Your stress test here is, let's say that the rate that your client would be paying would be 3.44. So you have to add a 2% over top of that. So your qualifying rate becomes 5.44. On the other option, on an insured loan, your lender would be offering you, let's say, a 3.19%, but you have to qualify your client on the BOC rate, which is now set at 5.14. So first of all, your buying capacity might be affected because you have to qualify on a lower interest rate because you're going insured. Second, even if here you're paying a premium to go insured. So let's say you're paying that $8,600 premium to benefit from a lower interest rate, your payment will still be a little bit lower if you choose an insured deal or an insured mortgage versus a conventional mortgage. And I'm not saying that one is better than the other. I'm just saying that the benefit for you to have Leo as a partner is that Leo is able to have the conversation with the client and let them know what their options are in terms of what products they're choosing. Is it insurable? Is it conventional? Is it high ratio? The rates, depending on the lender, depending on the products, and so on and so forth. And also establish those options and say, well, in the long run, over the period of 25-year amortization, how much interest rate will you have paid on an uninsured mortgage versus an insured mortgage? And or if you go on 30-year amortization because you want to lower your payments, then it's going to be up to the client to make the decision, saying, you know, at the end of that period, will, you know, do I save any interest on money on interest, or do I, you know? So there's a whole bunch of new options that are now available to your client, depending on the lender, depending on the type of product that they're choosing. You want to add something?
Just one quick point. Over here, guys, some of our lenders will still go 30 years, as Annie was saying, and this will, in effect, lower this.
If you put 20% or more.
If you put 20% or more,
20%.
exactly, because we can't go any higher than 25 for insured. So again, that option is available on 30 amortization, but the rate would still be higher. And in a longer period of time, then, you know, yes, their payment will be lower on 30 amortization, essentially, but they may end up paying more interest rates if you accumulate the total amount of what the interest rate will, or what the interest amount will be for them. Now comes some of our products that we're offering. And if we don't have time to go through these programs, we can always come back or do a webinar. Purchase Plus Improvements program is one of the options that you can offer to your clients. So let's say you've got a listing that's been sitting in the market for, you know, a couple of weeks more, and it's located in a perfect location, but it's sitting in the market because it has not been well maintained and it needs a little bit of renovations. But it's in a first-time home buyer market, so you would have the ability to offer through Leo to offer the Purchase Plus Improvements program to allow a client to buy, let's say, a condo unit at $450,000, and let's say they want to have a brand new kitchen because the kitchen is just not the way they like it. So they could combine the purchase price plus the improvements amount and come up with a 5% of that new purchase price. So let's say I'm buying that $450,000 condo. I want that $30,000 kitchen. My purchase price becomes $480. So I have to come up with 5% of $480. And that allows me to be able to make the renovations right at the time of purchase without having the liquid assets that I need to pay for the renovations up front, or even worse, using my line of credit that I would end up paying 7 or 8% on it, as opposed to incorporating it in my mortgage. Remember what I said about mortgage refinances that we can't do anymore? So let's say someone who bought their home with 5% down payment last year. Because of the market stabilizing itself, they probably would not be able to refinance their mortgage until they get to 80% loan to value, which results in them having to wait a few years before they can take some equity out to pay for the renovations. So if you have the ability to discuss with your clients the opportunity for them to have renovations done right at the time of purchase, then you know what, that might save them time, and that saves them money as well, and they can get the house that they want fully renovated, as long as it's less than $1 million, the way that they want it. Second very popular program, New to Canada. You've got clients that are new to the country. They've been here for less than 5 years. They're full-time permanent salaried, but they don't have any established credit as a result of obviously immigrating to Canada in over the past few years. They could be here with a landed immigrant status. They could be here with a work permit with a SIN number that starts with a 9. They could be here with a PR status without any established credit. DO can facilitate a mortgage with 5% down payment for newcomers to Canada. This will be the product of this, again, like because we are, the government is continuing to welcome newcomers to Canada. I think we're going to be welcoming over 450 new immigrants in our country. We've got 1/3 of all immigration population that comes into our market here in the Toronto area. So if you want to find some ways to advertise, increase your sales, that might be a good way to market yourself as well. Vacation homes, secondary homes. We are still allowing clients to buy a secondary home. Let's say I live in Newmarket, I work downtown, and I want to buy a condo unit so I can use it 2-3 days a week. I would be able to do that with 5% down payment. Alternatively, if you've got clients that are mom and dad, but they don't have the 20% down to give to their kid so that their kid can buy their house because the kid is still in university and he can qualify on their own, mom and dad could be buying a house or a condo, it's one unit for an immediate family member. So my husband and I would have a child who goes to university. I live in Newmarket and he goes to university downtown Toronto. Instead of renting an apartment for $2,500 per month, I may much rather buy a condo unit with 5% down payment, have my child to live in the property through a secondary home program or through the family plan program, which the family plan program allows your child to actually be on title as well. So once they're done school, they start working, they can qualify on their own, you can just release mom and dad from title. I'm just giving you options to know about so that you can have those conversations with the clients and be able to know that Leo can facilitate those mortgages as well for you. We still do stated income program for business for sales, so keep that in mind. I'm not going to go into too many details. Did I miss anything, Leo?
No, I think we covered it.
Yeah. So if you want to take a picture of this one, actually, it's a good one. It actually shows purchase price. It's a purchase plus improvement scenario. So if you compare straight purchase to a purchase plus improvement, let's say here for the same, so let's say I want to do $30,000 worth of improvements. If I want to do just a straight purchase transaction, my down payment would be $28,000. If I want to add $30,000 for improvement, my down payment, so with $1,500 more that I invest as a down payment, I can borrow $30,000 more on it. And your premium, your payment is slightly different. Like it's not that much different, but it allows you to purchase a lot more for your own needs. Oh, sorry.
And by the way, guys, Annie will email this to me and I'll send it to Marty and she'll distribute it to you guys, okay? And for future seminars, I think the Purchase Plus Improvement and Canada, those are, we can go really deep on those topics alone. So that could be conversations for future seminars, okay?
How about foreigners? Like if they are like foreign, they are not immigrant or
non-resident program. I don't think through Genworth, but we have.
Yeah, you can do that conventionally, but maybe not insured. Well, not maybe. You can't do them insured. And actually, the scenario 1 and 2 just compares if your client chooses to go with a line of credit, with monthly payments for a line of credit versus going with the Purchase Plus Improvement program, then they would be saving money there on the interest rate. Okay.
Sorry.
Yes.
What to say?
Okay. So this is a scenario 1 for Purchase Plus Improvements program, whereas client would be choosing to pay for the renovations themselves using a line of credit. Okay, so that $30,000. So the example is $400,000 from the previous slide. $30,000 line of credit for renovations. So your interest rate, let's say, just for the sake of this example here, your monthly payment just for the mortgage is $22.65. Your line of credit per month would cost you $307. So your total monthly payment would be $2,500. Versus if you incorporate your $30,000 in your loan amount, so you forget that, you include it in there. So your payment is slightly higher, so $200 more, because you're using that $30,000, you're including it in your purchase price. So it's just one easy payment using the same interest rate, 4.84, let's say it's a hypothetical rate. Your monthly savings would be about $140. Look at the interest rate difference as well over 5 years.
Now, Annie, quick question.
Yeah.
The borrower would have to front their own renovations out of pocket, and then once the renovations are done, you guys would reimburse and add it.
Exactly.
Okay.
So they just have to find ways to be able to pay for the renovations, either line of credit but the good news is that they don't have to leave it on their line of credit. They can just pay once the renovations are done, then the loan gets fully disbursed, and then they can pay themselves back. But this is something we could actually do a webinar specifically for that and go into details, because there's so much stuff that you guys could know about and help you to market it as well in your market. One thing I wanted to show you very quickly for realtors, this is very, very interesting. On our Genworth website, you've got a realtor section. So if you've got any questions on any of the products that we've talked about today, they're there. If you scroll down to my marketing source, this is a template. It's a library of already made templates that we are allowing you to use so that you can market, that you can advertise some of the products. So let's say you want to advertise a purchase plus improvements program. You've got an open house, and again, you know that the house is not showing the greatest. So you have that open house and you want to use the product overview sheet with your logo, your contact information, all of your details. You have an estimate of the potential renovations, before and after pictures, and you've got Leo's card, and you're like, this is a perfect scenario for a purchase plus improvement program, and I have Leo here who can facilitate the mortgage for you. We are allowing you to use the product overview for Genworth, and you can customize it with your picture, with your logo, and your contact details. And this is for free. So if you go to Realtors and you go to mymarketingsource.ca, I'm just going to show you what it actually looks like so you can register for yourself. Hello. Okay, so let's say if you go start a document, I'll just show you the different options that you can choose from as well. So let's say, depending on how you want to advertise, if you want to do prospecting, repeat buyer, first time, there's a whole bunch of different categories you can choose from. And let's say for the purpose of today's presentation, you want to use the Purchase Plus Improvements product overview. If you click on that, you go to Purchase Plus 2017 Purchase Plus Improvement. This is actually the product overview for Genworth, that you can just put your picture and your contact details. So because I already have a profile that's been created for me, so like when it's your first time, you just go at the top of the screen and you update your profile. But yeah, the system is a bit slow right now. Okay, so because I already have my profile, everything is already pre-populated. So let's say I do my picture at the top. You guys already know how to do that because you must be doing it all the time with your own marketing material, but so it's a PDF version, so you can choose to email it, print it, put it on LinkedIn or Facebook or whatever else, how you want to use it. So this is the finished product. So this is all my contact details from my profile, my picture, and this is the Purchase Plus Improvements program, the product sheet or feature sheet that you can use to market yourself.
Can we upload that also through our websites?
You can. Absolutely. It's just it's a soft document that you can save on your computer, you can print it, you can email it, you can post it on your website as well.
What term did you use on that line of credit versus the purchase price? Adding it to the mortgage? 2-year or 5-year or?
Oh, like for qualifying for?
Well, no, because you said comparable how much you're gonna pay more per month.
Yeah, so it would
what
be.
term did you use for that, for the line of credit?
So let's say it's an
3-year or
unsecured
5-year?
line of credit for $30,000 and then your monthly, once you
Right, but what
spend
term did you
$30,000,
use?
I think it's 7%.
Right, but for 3-year or 5-year term?
Well, it's an open line of credit.
Okay. Oh, I see.
Very good
You
question.
continue with it. No, that'll be a big difference.
Yeah, no, absolutely. And there's different types of products as well that banks can offer. So it just goes down to the client offering it. So in a nutshell, I think we do have a lot of different products to offer you, and I think Leo can facilitate a lot of those for you. We'd love to be able to be back eventually and talk about more in more detail on how we can help you increase your sales in 2018. Offer more client options in terms of the mortgage financing. Yeah, that being said, I'll stay later if you have any questions. Thank you so much for your attention. And if you want to thank us, support Leo. Send your next high ratio deal to Leo.
Thank you, Annie.